Hello, everyone, and welcome to this Energy Quick Chat where we rub minds with stakeholders and players in the energy markets. Now, oil prices fell early trade on Friday as traders took profits after prices soared to 10-month highs and expectations of supply increases by Russia and Saudi Arabia outweighed forecasts of positive demand from China during its Golden Week holiday. Brent crude were down to $94.97 a barrel, while U.S. West Texas Intermediate crude was at $91.70 a barrel. Julien Mathonniere joins me now, and he's an oil market economist at Energy Intelligence. Hi, Julien. How are you?
A very good day to you, Justina. I'm very well, and you?
Fine, thank you. Now, the oil price rally we've seen in the past week paused overnight. Where do you think they are headed as supply tightens?
Well, I think oil prices might surge above $100 per barrel. Yeah, it's not unthinkable at this point. I mean, you can see that prices have been swinging from supply resistance from OPEC at anything below $80 per barrel to demand rejection by buyers at anything above 100, maybe $110 per barrel. And you can see that the midpoint between the two is about 95, which is where we are now. So I think OPEC has been instrumental in turning the tide over the last few months, and as a result, our price outlook has been revised up by about $6-7. I mean, from $81 Brent on average in the first half of the year, we are now expecting $88 Brent in the second half of the year. So, those deep supply cuts, they will support prices. And we think Saudi Arabia will maintain its restraint to keep those prices buoyant. Now, if you look at macroeconomics, China, etc., it's still a little bit wobbly. So looking ahead, we could see $100 plus, but we don't think it's going to stay there very long, for all those macroeconomic headwinds.
Right. I think I heard the Saudi Arabia minister speaking about the fact that they'll keep reviewing those prices as the year comes to an end. Now, with Russia softening its ban on gasoline and diesel exports, as at yesterday, Russia said that the ban was indefinite and we shouldn't expect anything less. So what is the implication of this on the global oil market?
Well, if a ban lasts forever, obviously the impact of the market could be significant. Now, I need to bring a little bit of nuance to that. Refiners in Russia lack storage. So that's a big thing because, at Energy Intelligence, we estimate that Russian diesel storage capacity is less than 30 million barrels per day altogether, which would likely fill in about 2 or 3 weeks during the current maintenance period. So, Russian refineries are under maintenance. So things are getting a bit slower. But even with that ongoing, it will fill up quite quickly. Maybe the country can add 10 million barrels of diesel in inventories, but that's not entirely sure. After that, refineries would have to run slower or shut down capacity, which would make things even worse than the current situation, in terms of fixing the domestic shortages on the Russian market, which is why with this story about indefinite cuts, we're not entirely sure about it. Long story short, we may have only 2 to 3 weeks before Russian diesel start to flood the market again. And if anything, this will help mitigate, any spikes in diesel prices. That's a very possible scenario.
So where does this leave other commodities like gas and coal in the near term?
So I think both gas and coal are intertwined. It's actually a very good point you make that, you mentioned those two, because if you remember last year, high gas prices after Russia invaded Ukraine and Russian gas led some countries to turn to relatively cheaper coal, and notably Germany, where coal made a comeback last year. And as a result, coal consumption in 2022 went up by something that more than 3%, I think. And it's likely to stay high this year and next year because, price spikes have sort of dented confidence that natural gas was an affordable alternative to oil and even to coal, by the way, especially in Asia. So for now, if you look at Europe, because Europe is a big pain point in the global market. Gas stocks are very well filled. The weather is warmer than usual, especially again in Europe. But if that trend changes, say if the weather gets a lot colder, then there will be more demand for gas. And if prices reach the same, stratospheric heights as last year, then some power plant and some big industries will switch to coal. And this will support demand for coal, for coal and by extension, coal prices. So everything is linked together.
Right. Now, the International Energy Agency released its roadmap on net zero emissions. What do you make of that report and the rate of progress globally? Now, we know that OPEC made a separate speculation recently, and it was more like a difference in what the IEA was saying. So what do you make of this and the rate of progress globally?
Yes, you're right to point that out, Justina. They both disagree very much. For me, the main takeaway from the International Energy Agency is that this net zero pathway still represents an existential threat for oil and gas producers, because it essentially says, 2 years ago already in the 2021 report, that no investment is needed in new fossil fuel resources, beyond those investments that are already sanctioned or about to be sanctioned this year. And IEA Director Fatih Birol said that two of the transition's key technology, photovoltaic, solar on the one hand, and electric cars on the other hand, are now in line with the net zero trajectory. So, this is a threat for oil producers. And of course, as you mentioned, they're not very happy with that forecast because, this is now an official target for OECD. Whether we'll manage to reach it, I don't know, but it's definitely a goal. And I would nuance that by saying that the report also says that this net zero goal means that by 2035, advanced economies will need to have, reduced emission by 80%. An emerging economy would have to reduce emission by 60%. So, to me, it doesn't sound entirely realistic. And even the IEA admits that, it will take a huge concerted effort. Like they said, they use the adjective Herculean to reach this net zero goal. So, we are not there yet.
So what's your outlook ahead of the next OPEC GMMC meeting due on the 4th of October? I think that's next week.
Yes, probably I would think the status quo in terms of supply. Balances signal that the supply deficit should drain inventory, according to our estimates, by nearly 1 million barrels per day in the second half of the year, 900,000 exactly, compared with a small build of 300,000 barrels in the first half. Now, the OECD is expected to bear the brunt of that. The OECD tanks have already drained. I may have mentioned that already. But the problem was non-OECD and in particular China. China has gorged up on cheap Russian, Iranian, Venezuelan crude. And, Chinese inventory swelled by at least 90 million barrels per day. And, the risk is that China may decide to draw from inventories and stop buying crude to pressure global prices. And it seems the Saudis at the moment are obsessed by China's inventories. They want to know, what China is doing with their inventories and if they are going to use them and if they are going to use them against them. So OPEC may be forced to cut more, especially if countries like, Iran do not play ball with the rest of OPEC and continue to add supply like they did in the past few months. I think Iran has lifted crude production by 600,000 barrels per day. So they are now producing 3.15 million barrels per day. And we estimate that their technical capacity, is 3.65. It means that they could, in theory, they could have 1 million barrels per day of production. And if anything, then you could argue that higher Iranian exports are sort of undermining the Saudi effort to keep this market tidy and tight. And it will force the Saudi to cut more in 2024. So, again, that's another possibility. And you need also to keep at the back of your mind that we expect demand to be lower in 2024. So this might be, factors forcing the Saudi to keep the cut. So no change in the next meeting, but probably we expect some more announcements and some more cuts from the Saudis being extended in 2024.
Right. Hopefully that materializes, and we keep watching out for those numbers. Julien Mathonniere, oil markets economist at Energy Intelligence. Thank you so much for speaking with us on Energy Frontiers.
Always a pleasure, Justina. Thank you for having me. Thank you.
Yeah. That's it on our Energy Quick Chat this week. Thank you everyone for watching. I am Justina Okechukwu. Bye for now.